Alasdair Macleod, author of the Macleod Finance Substack. Welcome to the Competent Investor. Thanks for joining me today.
Nice to be with you, Tom.
Alasdair, we've been talking a lot about the repo facility and how this is a possible, let's say, sign of liquidity strain in the system. What do you think is the best way to kind of break this down to understand this problem, or if it is a problem yet, and what the possible consequences from here could be?
Yeah, there's been a lot of commentary that the repos spiked up to 29 billion
Mhm.
the other day, um, which was containable. I mean, we don't often see spikes like this, but I think on its own, it really doesn't matter. But there is no doubt that there is a liquidity problem developing in markets. And really, what's contributed to it is two things. Firstly, quantitative tightening, which has
Mhm.
taken liquidity out of circulation, as it were. And the second thing is that the US Treasury has been funding itself very substantially. It's been relying on T-bills for financing, which,
Mhm.
of course, absorbs credit from the money market mutual funds, principally, as well as the banks. But the point about money market mutual funds is that their subscribers basically pay out of bank deposits. So, what you see is that these funds go into the general account, at the Fed, the government's general account at the Fed. And with a lot of government operations in suspension because of the debt limit at the moment, it's not going back into circulation.
Mhm.
So we're seeing, if you like, a credit crunch, and it's just basically developing. And the Fed recognized this at the last FOMC meeting when it announced not only a quarter-point cut, it also said that it was going to end quantitative tightening and replace it with quantitative easing. So that's why. So, which is interesting because the big signal from that is forget inflation. That's not the problem as far as the Fed is concerned. And so they're just jacking up the money printing system again, or the
Mhm.
credit printing system. And I think it's the first real increase in cranking up, the credit system that we've seen for a little while. And,
Mhm.
quite honestly, it's going to be followed by more and more and more. And the reason it'll be followed by more and more and more is we have a debt bubble. Well, it's a debt come credit bubble in the markets. They always burst.
Mhm.
Credit bubbles always burst. I don't know when this one will burst. Might burst next month. Might burst next week. It might burst early next year. But credit bubble it is. And when it bursts, what does the Fed and the US Treasury do? Well, basically, they rescue everything.
Yeah.
They certainly rescue the banks. They rescue important businesses, small town stuff that can go to hell, basically. But the big stuff, zombie companies, basically, will be rescued.
Mhm.
And how do they do that? Well, basically, by debauching the currency. So we're going to see more of it. I think what we're seeing is the first in a series of steps which are basically leading to the end of the fiat currency system.
Alistair, you mentioned bailing out banks. Do you mean, the big institutional banks or more so the regional banks? Because, where I'm going with this is the idea that there is, as I understand it, bail-in legislation in a lot of places now. And I want to understand what the risk of that is.
Yeah, forget bail in. Bail in is nonsense. I
Okay.
mean, if anyone tried to bail in, um, bondholders in with bank bonds,
Mhm.
would immediately start a run on the banks.
Right.
That's not going to happen. I mean, it could happen, where legislators are stupid. But this was something that was introduced by the political class in the wake of the last crisis.
Mhm.
I remember Gordon Brown, who was our prime minister at the time, he was claiming credit for, rescuing the world from this financial crisis and all the
Yeah.
rest of it. And his mantra was, "You will never let the public have to pay for the rescue of the banks again." Come on. I mean, this it was it was lunacy, really. And if you create a condition whereby the bondholders say, well, to hell with this, we're getting out of this risk, then you're going to collapse the whole system.
Mhm.
So bail-ins, forget it. I mean, it is possible that some stupid regulators in another nation, in a general banking crisis, will try and bail in. And that could have nasty repercussions. But as far as the US system is concerned, it's not going to happen. As far as the Bank of England is concerned, it's not going to happen. As far as the ECB is concerned, it won't happen. And nor will it happen in Japan.
Mhm.
These are the big ones, if you like. And I think that's the important thing.
Mhm.
I would dismiss that. Instead, and when it comes to regional banks, I mean, the answer there is that, okay, a regional bank may go bust, but the deposit holders will be protected, not by the fund set up to protect deposit holders, but the depositors will be literally transferred to another bank. Another bank will acquire the balance sheet.
Mhm.
Less, less, if you like, some of the bad debts, or if the bad debts are transferred, they will be guaranteed or whatever. I mean, the various arrangements they will come to. But I think you're just going to get bigger and bigger and bigger banks, if you like, because the weak banks will all be absorbed. Now, this
Mhm.
is fundamentally different from what happened in the 1930, 31, 32. 10,000 banks went bust, but they were all small regional banks. You just had the new Federal Reserve system come into existence, and if you weren't in it, you didn't get rescued.
Mhm.
You know, not only that, but we had a gold standard, and certainly at 20.67 until 1933, 1934 actually, and that's the difference nowadays. So what happens now, I think, is that instead of banks going bust, instead of bad debts, instead of bankruptcies wiping out credit, credit will be wiped out by its value declining rather than its quantity declining.
Mhm.
And that is inevitable now because it is a fiat currency.
Mhm.
It's a fiat currency to facilitate um, its debasement, really. And I think we're on the last leg. This credit bubble is the largest in history. And on top of that, I mean, it looks like 1929 all over again because we've also got Smoot-Hawley Tariff Act Mark II, courtesy President Trump.
Yeah.
And I think in many senses it's worse than Smoot-Hawley because President Trump has injected huge, great uncertainty into the whole situation. And on top of that, there's America's reliance, if you like, on foreign trade is far greater than it was in 1929, 1930. And furthermore, you've got very sophisticated supply chains, which, you disrupt them and you can have an awful lot of unexpected problems. That
Mhm.
was a situation that didn't really exist in 1930. So I know that US economists who are sort of faithful to the Republicans are dismissing all this stuff about trade tariffs and how it's going to drive up prices and all the rest of it. But I mean they're completely driven by their own vested interests. The reality is it's bloody awful,
Mhm.
and it's going to undermine the US economy. It will do, and inflation is going to soar over the next 18 months. I mean,
Because of
and what
because of
you know,
going because of
well,
going back to QE.
it's going to be it's going to be triggered by all sorts of things. But I mean, basically, yes, QE is one of the things.
Mhm.
But just look at it in very simple terms, and that is that dealing with a credit bubble that is bursting basically will be facilitated by the debasement of the currency. In other words, the purchasing power of the dollar will go down. What does that mean? Prices rise.
Mhm.
It's as simple as that, really. And it's at the moment everybody's saying, well, interest rates have got to fall. I think the expectations, in spite of Powell's caution on the last FOMC statement about a December cut, I think the majority is still going for a December cut, and they're not looking really beyond lower interest rates.
Mhm.
But the fact of the matter is that if you get um, rising prices because the currency is declining in terms of its purchasing power, then you're going to get higher bond yields all the way along the curve. It doesn't matter what the hell the Fed does, but basically the cost of borrowing just soars because it reflects loss of possession of the money. Like, I'm lending you the money, so I no longer have it. The risk that you may not repay me, and now the risk I've got to sort of try and work out what is a dollar going to buy me in a year's time.
Mhm.
you know, and suddenly you're looking at bond yields from 10 years outwards going 5, 6, 10, 15, 20%.
Mhm.
I mean, and it probably won't stop there. So this is a time, I think, of maximum danger for credit.
In exactly that vein, Alistair, do you think that this is, you wrote an article recently kind of comparing Weimar Germany and the hyperinflation there to where we are at in the debt and the value of the US dollar. Do you think that this is, a reasonable allegory for this hyperinflationary territory and the death of the dollar?
Yes, I do. I mean, the reason I chose the Weimar Republic and the Reichsmark and how that declined is that it's the best documented situation of of a collapse of a fiat currency that we have.
Mhm.
And really, what you can pick up on it are two things. You've got the political imperative, which overrules any economic imperative, and at the same time, you've got the human response, uh, the human response to what is going on in terms of the value of the currency. And those are constants. Those things are all, the situation today is obviously very, very different from what it was in post-war Germany, post-World War One Germany. But if you just look at it in terms of the pressures on the political class, how things develop, and the interesting thing was that you had a credit bubble in 19 from about late 1920 into late 1921, and it's similar to today. Now, the decline in prices when that burst, measured in falling Reichsmark, was around about a third, 30% drop. But in gold, measured in gold, which is real money, don't forget, it declined by 93%.
Over what time period?
We're talking about over 6 months. They're about 6 months,
Wow.
and that actually is quite similar to what happened in 1929 to 32. I mean, it took a bit longer, like it took 3 years, 2.5 years. But Wall Street lost 90%,
Mhm.
89%, I think, to be accurate. So yeah, this is, if you just look at the psychology of the situation, just bear in mind the psychology, put to one side reparations and the sort of treaty in London and all this sort of stuff, um, and just look at it purely from the point of view of politicians dealing with a situation by trying to inflate their way out of trouble.
Mhm.
Um, Dealing with those political pressures and the response, if you like, the human response to what was going on. And you've got, I mean, so in that sense, just purely isolating those two factors, as it were, what happened in Germany between certainly following the end of the First World War, which was 1918, into the final collapse of the currency, which was November 23. You've got a pretty good template for what we're seeing. Now, the timescale has been very, very different. But I mean, one of the charts which I put together, which was absolutely telling in my view, was one of the gold price, as it were, in Reichsmarks and also in dollars. Now,
Mhm.
the timescales were very different. And the moves were far greater in Germany, but my God, the pattern is so similar. I mean,
Mhm.
it really is. It's exactly the same. Fascinating. And we are embarking roughly where they were in late 22. I mean, so in other words, on that basis, we've got the equivalent of a year of Reichsmarks ahead of us. Now, how long it takes for us for this to happen with the dollar, I don't know. Um, we can only guess.
Mhm.
But what I mean, we can see how this is going to happen, Tom. The first thing, I mean, well, we're already seeing strains, the liquidity strains. Okay, so the Fed starts cranking up the presses again, just as they did in 1922 in Germany. I mean, believe it or not, before that happened, the Reichsmark just really in 1922 was the best performing currency in the world. It rose against the dollar, which was the equivalent of gold in those days. It rose to the point like it doubled against the dollar.
Mhm.
I mean, this is quite remarkable. Um, and then, of course, later on in the year, it started declining again. But it came to the point where the bubble got popped, the stock market bubble got popped. The stock market had risen 300% from um, February 1920 to December 1921. 300%. It then started declining, and it lost in Reichsmarks, which were beginning to fall in their purchasing power significantly at that stage. It fell by something like a third. But as I say, if you measured in gold or dollars, which were the same thing then, 20.67 to the ounce, it was, well established, then it lost literally 93% top to bottom. And that was by around about, from memory, I think we're looking at around about middle 22.
Mhm.
So it was a sort of, 4, 5, 6 month wonder. Not pleasant. Now, our credit bubble equally is going to get burst,
Mhm.
and it will get burst either because it runs out of momentum or because bond yields start rising again. And I notice they are beginning to rise again, having sold off. Already, the valuation difference between the long bond and equities means that the valuation is now so stretched, it's more stretched than it's ever been in history, meaning that equities are more expensive relative to bonds than they have ever been in history.
Mhm.
So, some stage, that's, like a bit of elastic, it's going to snap. And we don't know at this stage quite what's going to snap it. My guess is rising bond yields will do it. We're already seeing little bits of trouble coming through. Bitcoin, for example, has now lost nearly 20% of its value from the top. It's losing momentum. It looks bloody awful on the charts. And the importance of that, of course, is that it correlates very, very nicely with the Magnificent Seven.
Mhm.
It's the same cohort, if you like, that have been buying the Magnificent Seven that have been buying Bitcoin. So you can see that what Bitcoin is telling us is that there's trouble, if you like,
Mhm.
in the momentum stocks developing. There may be now, we're going to see this liquidity injection easing things as far as the market is concerned in the short term. So I'm not ruling out one last spurt
Mhm.
in the equity market on the basis that this easing of liquidity is likely to fuel yet more buying of equities. I think that's quite possible, but that's a very short-term thing. And I think at this stage, anyone who's in the equity market is actually at very, very high risk, very high risk. Could go up another 10, 15, 20% by March next year. I wouldn't rule that out,
Mhm.
but I wouldn't bet on it. No way.
Mhm.
You never get the top in a credit bubble. If you do, it's just pure chance. Don't talk, and chartists who say that, oh, I'm terribly clever, I can get the top, My Elliott wave theory says that it's going to go wherever,
Mhm.
forget it. It's a nonsense, absolute nonsense.
Alistair, obviously, there's as you explained in the Weimar example that there's ups and downs, there's different starts and fits to this process.
Yeah.
So if and when we do get this credit bubble pop, do you think that let's say the run to safety and liquidity pushes a lot of people into the dollar, which increases demand and price of the dollar?
No, the problem here is that if you look at the Treasury tick figures,
Mhm.
foreigners own roughly $20 trillion worth of equities, US equities. So you got to think, what are they going to do once the bubble pops? They're going to get hell out of equities. What do? Just put it on deposit?
Mhm.
No, when things go wrong, it won't just go wrong in US equities, it will be going wrong in equities around the world. So, from a practical point of view, if you are managing a portfolio, say in Germany, for German clients, you're going to sell the foreign stuff, not your domestic stuff.
Mhm.
So this is the problem, I think. That, you'll find that foreigners are stampeding out of the dollar. The interesting thing is, and I think the question really, which I think a lot of people will have on their lips, is how will this affect the gold price? Will it mean that people take profits in gold? I don't think so, because gold is under-owned. Now, I wouldn't say that um, the establishment might not be tempted to mark prices down, but I think they would run into buyers if they did.
Mhm.
I think where the danger lies more is probably in mining stocks. They will be sold
Mhm.
because I know they're not widely owned, but the few people who are fortunate enough to own them as part of a portfolio. They've already got, the Magnificent Seven, AI stocks, all the rest of it. They are bound to, try and sort of offset the losses by taking profits on their mining stocks. So I think the mining sector could be hit harder than, say, gold or silver.
Mhm. Alistair, with this pullback that we've seen in the metals prices over the last 2, 3 weeks here, do you think that this helps alleviate the delivery issues and the pressure that we saw out of London?
No, it's a short answer. I mean, there's still a backwardation. There's still a backwardation in silver.
Mhm.
I mean, okay, it's not as extreme as it was, um, but I mean, and if you look at gold, I mean, gold never went into backwardation, but I think that's been better handled, if you like, by the establishment. The establishment now knows that gold is rising. I mean, if you want evidence of this, the LBMA's annual meeting, which was what, a week or two ago. I mean, they do what they always do. They ask all the attendees, what's your forecast for the price of gold and for the price of silver and all the rest of it, in 2026. And the average of all those expectations came out at just under $5,000.
Mhm.
Um, what that tells me is that the bullion banks, the refiners, and the various other members of the LBMA do understand that gold prices are going higher. Now, um, we needn't discuss whether they actually know what they're talking about in economic terms. I mean, we can only guess at that. But I think that behind this, there is a greater acknowledgement, if you like, that they're going to be supply difficulties when it comes to physical metal, for the simple reason that what happened earlier this year, when the trucks were queuing up outside the Bank of England to take gold out of the vaults and ship it over to COMEX, this, I think, quite clearly signaled to the central banks, who basically store, I mean, all the gold in the Bank of England basically is central bank gold. I mean, a lot of it is leased, so technically it is actually owned by others, by non-central banks. But this is under lease. Now, the way in which this has worked in the past is quite simple. Bank of England turns around to, say, the Bank of Austria or whatever, and says, yeah, we can lease your gold. It'll earn you income. You'll earn 1.25% on it, whatever, which means that you will make a profit. It'll pay for all your cost of storage and all the rest of it. And it will be done by book entry transfer so that it remains in the bank, in the
Mhm.
bank's vaults. And of course, it's got to be stored somewhere. So there's no point in taking it out of the bank's vaults. What it has meant is that it has provided liquidity for the London market in particular, where it's been hypothecated, rehypothecated, re-rehypothecated over the life of the lease. And of
Mhm.
course, at the end of the lease, it hasn't been a problem because the bank could easily persuade the Bank of Austria to extend the lease, or alternatively find someone else to provide a new lease.
Mhm.
But now all the central banks have been put on notice that if you lease your gold, you might lose it. Do you see what I mean? So I think the liquidity issue in London is actually very much in the back of the minds, if you like, of the bullion banks and the LBMA membership in
Mhm.
terms of future liquidity. They are not short, and they are not short for that reason. I don't know that they're properly long. I don't think they are necessarily, because quite a lot of their long position, I think, will be with other paper. For example, through forward contracts. They would have bought forward, or alternatively, they would have taken out option positions and sort of capped their potential losses.
Mhm.
And on top of that, of course, you have unallocated accounts. I would guess that the unallocated accounts are not properly covered. I I think if you have a sort of rule of thumb that an unallocated account is probably only backed by 10% of gold. But as far as the bank's books is concerned, other than the unallocated accounts, I'm sure that the banks in London are
Mhm.
long. And but they've got to stay that way. And they realize the constraints, if you like. I think this is really what's going on in gold. The thing that upsets the whole system, of course, is when the general public decide that they want to buy gold or they want to buy silver, which they do generally through ETFs. And particularly with silver, if you look at the ETF storage in London, it's something like 80% of, or it accounts for something like 80% of the silver stored in the LBMA vaults. Um, the other 20% is owned by others and includes some liquidity, perhaps, if you're lucky. So you can see that if, let us say, the general public decides we're going to buy some silver, which means that the ETFs go into the market and increase that proportion, if you like,
Mhm.
of their silver in the London vaulting system, the squeeze has only just started. I mean, it really has.
Mhm. Well, as we're on the subject of silver, Alistair, there seems to be many signposts in this market right now. And I think, an interesting one that I saw the other day was this idea that um, China is going to be stopping shipments of silver out of the country. Does that also show us stress from a different point? And, obviously that country's desire to protect what it has.
Yeah, that's right. There has been a big shift, I think, in the Chinese authorities' approach to silver. I mean, in the past, they've basically accumulated silver. They've controlled the price. I mean, the suppression of the silver price, I put down to the Chinese.
Mhm.
And I mean, I think in 2023, they supplied, I can't remember the figures, but I mean, something like 200 million ounces or something, figure like that to the West. And the interesting thing was that they supplied it to London, they supplied it to Hong Kong, they supplied it to Singapore. I think there was somewhere else. I mean, these are all financial centers.
Mhm.
You know, these are not manufacturers. In 2024, the financial centers came out of it, and it was supplied more to, countries like India who manufacture solar panels and all the rest of it. I think it's probably stopped now. Um, and if you look at the Shanghai Futures Exchange, the vaulted silver there has dropped very substantially. Um, I'm told that the view is that if it goes down close to 500 million ounces, then we've got real trouble.
Mhm.
Well, it's going that way. So, and interestingly, I mean, we wake up in the morning here in Europe and find that gold and silver are going better during Hong Kong's trading hours or Shanghai's trading hours. And we're trying to put a lid on it. That, as you can see today, I mean, we were up to what on gold we were up to what 4,020, and this afternoon, guess what? It's drifted back to something like 3,980.
Mhm.
So the sellers, and they're not serious sellers at all. I think they're managers, if you like, rather than sellers, have managed to get it done by something like $40 off the top. We'll see what happens overnight again.
Mhm.
I mean, there may be a bit of profit taking because obviously ahead of the weekend, I mean, the Chinese are wild punters too. I mean, when it comes to futures and things like that, they may well take some profits ahead of the weekend. So we might see some more weakness tomorrow. I don't know.
Mhm.
But the underlying situation is that the stuff is running out of the vaults, and sooner or later, there's going to be a huge great conflict between the physical market and the paper market.
Mhm.
And we
And
know
just
who
for
will
some
win.
just for some context for listeners, we're recording this on November 6th.
Yeah, good point.
Mhm. Well, we have to be specific because of the volatility that
Yeah,
we're seeing in these times.
exactly. I think, yeah. And if we're talking about market prices, it's sort of, it's got to be relevant, hasn't it? Yeah,
Mhm. So, Alistair, you wrote another article recently about how much gold you think China could actually hold.
yeah,
How is this also split? Like, what is that number, and how is it also split between the government and private hands?
yeah. The problem really with assessing what China owns is that they're very secretive about what they have bought. Um, uh, if you like, and I don't know the answer. I really don't know the answer. So what I've done is I've tried to work out on the information that we have what the answer is likely to be. My starting point in this was that the regulations appointing the People's Bank of China with the sole responsibility for acquiring the nation's gold and silver date from 1983. Now, it was at that time, I mean, Mao died in what, 79 or thereabouts. There was a massive inward investment going into China. And certainly from the early 90s onwards, the trade surplus was beginning to rocket as a result of all the factories that were being built
Mhm.
in China by American corporations, mainly, and to a lesser extent, European ones. So, I mean, at the same time, we had a bear market in gold.
Mhm.
I mean, a huge, great bear market in gold. And so this was an ideal time for the Chinese to pick up gold in particular. Silver was a slightly different thing that was done in a different way. But I reckon looking at those foreign exchange flows, which again were the monopoly of the People's Bank of China. So, I mean, they were handling both paper and physical, paper currencies and also physical gold, physical money. Um, I reckon that just putting 10% of those flows across their desk, foreign exchange flows across their desk, into gold meant that by 2002, and I'll come back to that date in a moment, by 2002, they'd accumulated somewhere between 20 and 25,000 tons. Now, of course, at the time, the official reserves were something like 300 tons.
Mhm.
and they raised it to 600 or something. 2002 is important because that was the date when the Shanghai Gold Exchange opened and members of the public in China were allowed to buy gold. Since then, if you look at the withdrawals from the Shanghai Gold Exchange, they total nearly 28,000 tons. Now, that is gross, if you like, because some of that would have gone back into the vaulting system. Because if you're going to scrap, scrap gold goes in, even if it's bars, physical bars which have been taken out, everything that goes back in is scrapped and re-refined into 4/9 kilo bars.
Mhm.
So when and of course the other thing is that there was a massive investment by the state in gold mining, and they rapidly became the largest gold miner in the world, and they have produced something like another 10,000 tons on top of that. As well as that, we know, and the whole thing became a bit of a sort of mantra, that gold was flowing from west to east, and it's been doing that for what, 30 years, so far
Mhm.
as we know. And we can add to that China is like Hotel California for gold. You can go in, but it doesn't come out. It's
Mhm.
as simple as that. So, putting all this together, and the other thing which we ought to mention is that the major banks in China offer gold accumulation accounts to their depositors.
Mhm.
And if you look at the sort of current situation, household savings are 35% of GDP. That is the equivalent of something like $4 or $5 trillion
Mhm.
accumulating every year. You had a property crisis, which stopped that. Bank deposit rates have been reduced and reduced so that the deposit rates, the deposit accounts have been paying less.
Mhm.
So we don't know how much has been going into the gold accumulation accounts, but that gold is still held within the Shanghai Gold Exchange's vaulting system. It doesn't get delivered out of it.
Mhm.
I think it's probably another 10, 15,000 tons or something from that. Adding the whole thing together, I came to the conclusion that we were looking between the state and also the population, we're looking at a figure like 70,000 tons.
Mhm.
Now, 70,000 tons, you've got to bear in mind that the total above ground stocks are around about 200,000 tons. They're not 220,000 tons, incidentally, it's 200, not 220, which everybody talks about. So 35% of above ground stocks are in China. This is massive.
Mhm.
Why would they do this? Which must be your next question. They would do this because the Chinese knew, if you go all the way back to the training of economists in the Marxist universities, they knew that the capitalist system was basically corrupt and it would fall apart,
Mhm.
and their currencies would become valueless. They knew this. So when they started playing the capitalist game, then they knew they had to protect themselves against the eventual currency collapse. They arrived at the right answer, not necessarily through sort of education I would condone, but by chance they've got the right answer.
Mhm.
And this informs not the Chinese who've been subsequently trained in Harvard and all the rest of it. I mean, there's you've got a whole generation, if you like, who've had this knocked out of them substantially. But the wise heads in actually running the Communist Party still understand this, and they see it because they're playing a geopolitical game apart from anything else, and
Mhm.
they understand that when they beat America back out of controlling the whole world, that the use of the dollar is going to decline. And you don't need to be the brain of Beijing to actually understand what that does to the value of the dollar.
Mhm.
Okay, so what are they doing? We have got this capricious President Trump who runs around and sort of starts, I mean, basically destroying America's dollar by running around, putting tariffs on everybody, changing his mind every 5 minutes, etc., etc., etc. What did that do? It drives everybody into arrangements which exclude America,
Mhm.
because America is an unreliable trading partner. And so you remember, I think it was April the 2nd, when he was holding up these boards saying, China 50%, or whatever it was, all the, I mean, the whole thing turned out to be meaningless rubbish. But the first thing that happened was the negotiations between Japan, South Korea, and China to have a trade bloc between them were accelerated. The second thing that happened was that President Xi had a whistle-stop tour around Southeast Asia, going to Cambodia, going to Vietnam, going to Malaysia, going to Thailand, whatever, whatever, whatever. He had a week of talking to these guys. These are the, if you like, the core of the ASEAN free trade area. Yeah. We're looking at a very substantial network of populous nations. We're talking about quite a large element of GDP. That's being free trade. So in other words, what we're seeing is that China moved immediately to counteract the danger, if you like, of President Trump. They have more or less insulated themselves from it. And indeed, if you look at their exports to America have declined, but at the same time, their exports around the Shanghai Cooperation Organization and also BRICS have increased. They are not nearly as dependent on America as they were. And this is planned. I mean,
Mhm.
it's as simple as that. So the next thing that happened, and I'm sure this was all part of what President Xi was saying to the various presidents when he did his whistle-stop tour, was we will open vaults outside China so that you can exchange gold for yuan and vice versa.
Mhm.
So shortly after his trip, it was announced that the Shanghai Gold Exchange was opening a vault in Hong Kong and one in Riyadh. Why Riyadh? Because the Saudis export an awful lot of oil and need that foreign exchange facility. If they're going to be paid in yuan, they want to have the facility, if you like, to see that it's backed by gold. It is effectively a gold substitute, and for
Mhm.
trading purposes, that is exactly what they're doing. And I see that Cambodia has now said that they're going to store their gold in the Shanghai Gold Exchange vaults. That came out, what, 3 days ago or something. So,
Mhm.
basically, the dollar collapses, the yen collapses, the euro goes, down to hell, sterling is going to fall off its cliff, and the Chinese will very rapidly tie the yuan to gold to stop it going down the same tube.
Mhm.
So we can see why they have accumulated gold, and this is Hotel California. This stuff comes in, but it never goes out. It's too valuable.
Mhm.
And of course, they now control the gold market completely.
Mhm. Alistair, what do you think of the developments on the other side of that, though, where they've recently also started offering interest or a yield on gold holdings? Is that what could be the incentive behind that? Is that to bring more gold into the banks and the public system out of private hands?
Well, I must admit, I haven't actually seen that.
Okay.
Um, but what I would say is that gold does bear an interest rate. It's a very low interest rate. I mean, you're looking at less than 1%. I mean, to understand that, you have to understand what an interest rate is. It's compensation for the loss of possession
Mhm.
in the case of gold. And also, there will be if you're going to loan your gold to someone, there's also not just loss of possession, but also the risk that you might not get it back.
Mhm.
Talk to the people who've leased gold I mean, in the West.
Mhm.
Um, so, I mean, the one thing that isn't a factor is fear of loss of purchasing power,
Yeah.
which is why, if you like, I mean, to give an example, which is why the sterling rates have to be higher than almost everywhere else because nobody trusts the government. Everybody thinks that the purchasing power of sterling will decline. I mean,
Mhm.
they're not really sort of putting it quite in those terms, but the inflation outlook, which is the macroeconomic way of looking at it, is not that good in the UK, and they're obviously hoping that it won't run away. But you can see that, yeah, gold does have an interest rate.
Mhm.
We mark this by seeing the lease rate, for example. That's very definitely there.
Do you have any indication that Russia is basically doing the same sort of playbook, like with increasing their holdings and basically taking the same path as China?
Yes, absolutely. It's slightly less obvious. I suppose the Chinese situation isn't obvious to people who don't look at it, but yeah, I mean, Russia is going that way.
Mhm.
Uh, they've invested a lot more in mine production. They are at the moment the joint second largest mining nation in terms of gold, along with Australia. I should think they'll very soon become second only to China, and not all that far behind China. The the central bank, has accumulated quite a lot of gold. I think the figure is something like 2,400 tons or something, which, given the size of the economy, means that it's pretty well backed. I mean, they could go on to a gold standard, but the other thing is that there are two um, uh, sovereign wealth funds, if you like, in Russia. One of which is a precious metals fund, and the other is a more general one. And intelligence sources, which come to me via another, if you like, another avenue, suggest that they've got about 10,000 tons there. So they could actually mobilize more gold to back the ruble than the USA has
Mhm.
to back the dollar.
And do we have, I mean, obviously a lot of this is speculation, but do you have any indication of the US still having its 8,100-ish tons?
We don't, obviously, we don't know, but I think the behavior of America rather suggests that there is a deficiency there.
Mhm.
Draw your attention to two things. Firstly, we know that following sort of mid 1980s, when the LBMA really got going, there was a big carry trade whereby uh, um, hedge funds would borrow gold from, lease gold, swap gold, mainly lease gold, and it was central bank gold. Central banks were sort of, it was to them at that time, it was a sterile asset. The value was going down and you're sitting on this stuff. Why? Because someone said you should sit on it. But, I mean, for goodness sake, we're mark to mark losses. I know we don't run that on our balance sheet, whatever. You had all this sort of hassle, as it were, with gold for as far as central banks were concerned. But what the lessees would do is they would sell that gold into the market for dollars
Mhm.
and then invest those dollars. I mean, the leasing cost, incidentally, was about 1%. Okay. They would then sell those dollars into the market and apply the proceeds to the purchase of T-bills,
Mhm.
which at the time, I mean, in 1984-5, they were yielding 9%. And okay, it declined over the time, but you were still getting 5% at the turn of the century. So it was the original carry trade. It really was.
Mhm.
Frank Veneroso did some very important research on this, and he concluded that by 2002, uh, something between a third and a half of all central bank gold had actually disappeared into leases. Now, where is it gone from? I mean, I think London, some of it's probably gone from London. I don't know. Not an awful lot. Because remember what the Bank of England does is it runs a book transfer system. The Americans had a greater interest in suppressing the price because it was trying to get gold out of the monetary system entirely
Mhm.
to give the dollar a free run. So the, the finger of suspicion has got to point to the Americans
Mhm.
actually disposing of quite a lot of their gold and not recording it, for public consumption.
Mhm.
The other thing is the other bit of evidence we have, of course, was the experience of the Bundesbank trying to recall uh, its gold.
Right.
And there would have been discussions before the issue became public,
Mhm.
um, and I can't remember how much. I think they had something like 1,200 tons or 1,500 tons stored with the Federal Bank of New York
Mhm.
on an earmarked basis. The Americans refused to let them go and look at their property. They refused the Bundesbank permission to audit it.
Mhm.
That was a big red flag. And then, after the negotiations and all the rest of it, I mean, it was obviously quite clear to the Bundesbank that the gold wasn't there. But they had to get some back because there was an awful lot of pressure on the Bundesbank from the German population, from the German financial community, from the hard money men in the Bundesbank. They had to do something about this. And it ended up, they got what, 12 to 1,500 tons out there. What do they end up with?
Mhm.
Well, we'll deliver you 300 tons over 7 years.
Right.
Yeah. So this is as good as a statement that they didn't have it. They had secretly disposed of earmarked gold, the possession of other central banks. I mean, for God's sake, this we've now got, and this is actually extremely important because we now have the end of the fiat currency system. The only way in which you can secure the value of the dollar is to attach it somehow to the value of gold.
Mhm.
They can't do it. So where does that go? Gold, sorry, the dollar basically has got nothing to prop it up once it really starts sliding.
Mhm. It's incredible to think as well, even if they have let's say the 8,100 tons, what the value of gold has to be considering the value of the currency that has been printed over the last 40
Yeah,
years.
I know lots of people try and sort of work that relationship, but it's the wrong thing to do. It really is.
I agree.
Um, the only thing that matters is that you've got to have sufficient gold to ensure at all times to ensure that that the dollars can be exchanged for gold.
Mhm.
Now, you don't. I mean, you go back to in history, and basically, Sir Isaac Newton reckoned that you should back your paper by 40%.
Mhm.
Okay, you don't need to do that. You need to run a credible gold exchange system. But what it also means is that you must stop trying to manage the economy and understand that the role of interest rates is to manage your gold reserves.
Mm.
If you've got to run on your gold reserves, raise your interest rates.
Right. Because that
You know,
incentivizes people to come
yeah,
into the currency.
yeah, absolutely.
Mhm.
Because you will raise your interest rates, and then you'll find that gold starts flowing in
Mhm.
from elsewhere. Because remember, your dollar at that stage is a gold substitute. It is as good as gold.
Right.
But for that to remain as good as gold, you have to ensure that the gold is to back it. So what you do is you raise the interest rate, and then it comes out of other centers on a pure arbitrage basis.
Mhm.
I mean, there's enough historical evidence that that's the way it worked, as well as, in theory.
Right.
It was the mistake actually that the Bank of England made in the middle of the 19th century, and the authorities, I mean the government at the time, in framing the Bank Charter Act of 1844. It failed. The Bank Charter Act had to be suspended, I think, three times after that,
Mhm.
because the bank ran out of gold. I mean, the reserves ran down to sort of crisis levels. Why? Because they were maintaining interest rates with a view to, sort of supporting the economy, sort of thing, or supporting the banking system. Of course, the other thing they didn't realize, which was very stupid in framing the act, was that it wouldn't be ordinary people turning up with their pound notes, saying across the counter, you promised to pay the bearer. We've still got this on our banknotes, incidentally. I promised to pay the bearer the sum of whatever the banknote is
Mhm.
on demand, signed by the chief cashier of the Bank of England. We still have that. If you did that, I mean, you could do that under the gold standard, but um, uh, that wasn't where the run was. The run was on bank deposit accounts, not in cash. So you can see that it's vital that the issuing side of the bank has control over interest rates, not the banking department.
Mhm.
They just have to live with whatever the issue department does. So it's quite simple, quite
Mhm.
simple. But I can't see how the Americans have got to go get over the problem that first of all they need to properly audit, independently audit what they've got. Quite a lot of it, I should think, is probably undeliverable anyway. So that might have to be re-refined.
Mhm.
This, and not only that, but the whole system, the whole of the Treasury Department, um, they've got to do a complete volte-face in terms of their thinking. They've got to dismiss all this macroeconomic rubbish, which they've stuck in their minds, and go back to basics.
Mhm.
Pre-Keynesian basics. They've got to understand that. Uh, I, you know, and also you've got the political thing. Because going back to the Weimar Republic, what really killed it was that interplay between the politics and the public.
Mhm.
Economics don't come into it. So, so yeah, and America's got the problem that it's got this myth that it's got 8,130 tons. It is a myth. The evidence strongly points to it being a myth.
Mhm. Unfortunately, time is going to reveal how big of a myth that is,
It
right?
always does. It always does. Yeah.
Yeah. I
Ours
think
is
that's
not
a
to know the future.
yeah. Well, and it's so interesting how it always rhymes with the past as well.
Oh yeah, I mean yeah, rhymes. Yeah, I mean it's a bit of a cliche now, isn't it? But it's so right. But there are various ways in which you can read the past, and I think the skill is to try and read it correctly, if you like.
Yeah.
I mean, I've seen economists from different schools reading the same data and coming up with completely different conclusions.
Mhm.
MMT in Austria, for example, the Austrians. I mean, they'll look at the same data and just give a completely different interpretation,
Mhm.
which is why data actually is not the best guide,
Right.
but pure a priori theory is the
Mhm.
only way to do it.
Well, Alistair, I think that's a good place to kind of wrap up for today. Is there anything that you're really keeping your eye on in the near term here that is
Yeah.
going to be impactful?
Well, I think we basically I'm waiting for this credit bubble to burst.
Mhm.
I think hopefully I've got the message over that the valuation disparity between equities and bonds is now more stretched than it's ever been in history.
Mhm.
Um, Over twice, nearly three times as stretched as it was at the time of the dot-com bubble, which is very, very concerning. That is going to burst, and I think the moment that bursts, you know that everything is going to start running downhill very, very rapidly as far as the fiat currencies are concerned.
Mhm.
That will give you your timing. That's
Yeah.
the important thing. So I'm watching that and the developments around it very, very closely.
Okay. Of course, for anybody that wants to read more of Alasdair's work, it's all available at alasdairmacleod.substack.com. And of course, excellent X follow as well at Macleod Finance. Alasdair, thank you so much for your time today.
Thank you very much for having me on, Tom.